The market went green on July 9th, but this was not an everything is fine rally. This was more like, we will fund the winners, we will ignore the weak spots for one more session, and we will keep watching oil and rates like they are sitting too close to the edge of the table. That is the tension in this brief. Who got funded? Who got left behind? And what did the market decide to care about after the oil scare cooled down? The S&P 500 rose 0.8%. The Dow gained 0.3%. The NASDAQ jumped 1.3%. The Russell 2000 added 1.2%. Brent crude fell 2.2% to 76.30 after Wednesday's spike. The 10-year Treasury eased to 4.54%. The 30-year closed at 5.05%. That is the scoreboard. Helpful but incomplete. The clean read is this. July 9th was a conditions-attached risk-on day. The market did not say everything was fixed. It said if oil stops jumping, if long rates stop climbing, and if the worst energy disruption scenario looks less immediate, then investors are willing to buy risk again. But they were not buying every kind of risk with the same enthusiasm. They bought the AI and chip leadership. They got some relief from oil and rates. They still had to deal with a war risk premium. They still had consumer pressure from PepsiCo. They still had small business pressure from tariffs. They still had housing affordability sitting there like an unpaid bill on the kitchen counter. So this episode is not one giant AI essay. AI matters a lot in this tape because the market clearly rewarded the physical AI build-out, but the fuller market brief is broader than that. The day had 5 moving parts. 1, stocks recovered. 2, oil cooled, but geopolitics did not disappear. 3, long-term rates eased just enough to help risk appetite. 4, chips and AI infrastructure led. 5, the real economy signals were still mixed. Consumer budgets, housing, labor, and tariffs were not screaming all clear. That is the part I think people will miss if they only look at the index color. The July 9th rebound was real, but it was selective, and the selectivity tells us more than the green close itself. Let me put it into the recurring radar format. Risk appetite improved. Oil shock risk eased but did not disappear. AI build out stronger. Consumer pressure still visible. Housing pressure still ugly. Small business pressure still rising through tariffs and input costs. Broad market health, selective, not clean. That is the useful snapshot. If you are new here, this is the system I want these briefs to build over time, not just stocks were up or stocks were down. The point is to track what the market is rewarding, what it is ignoring, and which pressure points are starting to matter before they become obvious. There is also a continuity piece here. In the previous brief, the market was worried that the physical bill was rising, oil, war risk, long rates, and the cost of building the AI machine. July 9th did not erase that problem. It changed the temperature. Oil eased. Long yields eased a little, and that was enough for investors to return to their favorite trade, AI infrastructure. So the update is not. The physical bill stopped mattering. The update is the bill got a little less scary, and the market immediately went back to funding the companies it believes can handle it. Before we go deeper into Micron, here is the full day map. This was a market mood day. The mood improved because oil and yields eased. The leadership improved because semiconductors bounced. But the macro picture did not fully improve because consumers, housing, small businesses, and geopolitics still had pressure in them. So if I had to put the whole brief into one sentence, it would be this. Wall Street got calmer, but the world did not get simple. Let's start with the strongest equity signal. Not the only story, but the one the market rewarded most clearly. Micron was one of the strongest forces lifting the S&P 500 up 4.5%. That alone is worth paying attention to. But the more important part is why. The Associated Press reported that Micron cited surging demand for memory in the AI era as it updated the market on construction in central New York. Then Micron's own release made the bigger point even clearer. The company said it is increasing planned U.S. investment to more than $250 billion through 2035. Pause there for a second. Not million, Not a cute little pilot project, more than $250 billion through 2035. And the company says that is being driven by AI-era memory demand. This is where I think the market is telling us something important. The AI trade is no longer just a story about code, models, chatbots, or even GPUs by themselves. It is becoming a story about industrial capacity. Who can build the fabs? Who can secure the wafers? Who can line up the materials? Who can finance all of it without blowing up later? Micron also announced a separate plan to invest up to $3 billion to strengthen the U.S. semiconductor ecosystem. That includes $500 million in support for Global Wafers America and a 10-year supply agreement for raw silicon wafer capacity. That part matters just as much as the headline CapEx number because it tells you the build-out is moving one level deeper into the machine. This is not just we are building more memory. It is, we want the inputs too. We want the upstream supply. We want more assurance that the manufacturing chain inside the U.S. can hold. That is a very different kind of tech story. It sounds less like the old venture capital fantasy of software scaling frictionlessly across the world. It sounds more like industrial policy wearing a chip badge. And the market likes that right now. Why? Because when oil eases and yields stop climbing for a day, investors go right back to the companies that still have a credible growth runway and enough strategic importance to justify very large spending plans. That is the rotation. Not just back into risk, back into the companies the market believes can own parts of the physical AI stack. I may be over-connecting the dots a little, but this is the pattern I keep seeing. Capital is not leaving the AI theme. It is getting more choosy about where inside the AI theme it wants to live. It wants the builders. It wants the suppliers. It wants the firms that can secure critical inputs. It wants the names that can keep moving, even if the rest of the macro backdrop stays annoying. That is very different from a broad everything rally. And it also explains why a calmer oil print and a slightly easier long-end Treasury yield mattered so much. The market is basically saying, if the outside stress backs off a little, I am immediately willing to pay up again for the companies building the machine. If you like market briefs where we do not just read headlines, but connect oil, rates, AI, housing, consumers, and stocks into one picture, subscribe. That is the whole point of this channel. Make the market feel less random without pretending it is simple. Now let's talk about why the market got more comfortable in the first place. The obvious answer is oil. Brent gave back a chunk of Wednesday's jump and fell to 76.30. That is still above the 71.80 level from the end of last week. So this was not some magical return to peace and quiet. It was more like the market stepping back from the ledge for a minute. The Associated Press also noted that the 10-year Treasury yield fell to 4.54% from 4.56% late Wednesday. Treasury's own daily curve data showed the 30-year at 5.05%. That may not sound like much. 2 basis points does not exactly scream drama, but the market is living in a very touchy relationship with long-term yields right now. When those yields rise, the math gets harsher for future growth. When they ease even a little, pressure comes off. Here is the beginner-friendly version. Long-term yields are one of the prices of money. Not the only one, but one of the most important ones. If that price rises, mortgages get uglier, long-duration stock valuations get harder to defend, and big capital projects have to clear a higher bar. If that price drops a bit, the market starts breathing through its nose again. That is basically what happened on July 9th. The physical scare got a little less intense. The financing scare got a little less intense. And the market immediately leaned back into the winners it already wanted. But I want to underline something important. The underlying geopolitical problem did not go away. And this is also how I want to handle geopolitics in these briefs. Geopolitics is not only Iran. It could be China and Taiwan. It could be Russia and Ukraine. It could be sanctions, shipping routes, defense spending, cyber attacks, rare earth restrictions, or some random policy move that suddenly matters because it hits trade, inflation, oil, semiconductors, or currencies. The filter is not, is this a huge world story? The filter is, did this change what the market had to price On July 9th, the market-moving geopolitical channel was Iran, Hormuz, and oil. AP reported that the U.S. hit 90 targets across Iran and said the goal was to reduce threats to freedom of navigation through the strait. That same waterway carried a fifth of the world's traded oil and natural gas before the war, so the market did not rebound because the region became stable. It rebounded because traders decided the worst near-term oil outcome was a bit less immediate. That is a huge difference. And if you are watching this series for the bigger pattern, here's the important point. The market is still extremely sensitive to whether the physical bill is rising or falling. That is true for the whole economy. But it is especially true for the parts of the market that are already priced for a very ambitious future. The AI trade can tolerate a lot. It cannot tolerate an endlessly rising energy bill, a fresh inflation scare, and a relentless climb in long rates without eventually getting questioned. So July 9 was not problem solved. It was pressure eased enough for the preferred trade to breathe again. Now for the part I think is easiest to miss if you only watch index levels. The same tape that rewarded Micron also gave us a reminder that a lot of the broader economy is still not operating under those conditions. The New York Federal Reserve published new research on small businesses and tariffs. The headline finding is not especially comforting. About 80% of firms nationally reported that their imported input prices rose in 2025 compared with 2024. And firms dealing with tariff-related challenges were more pessimistic about their 2026 revenues and employment plans. This is where I would be careful. When we talk about tariffs, it can get very abstract very fast. But the simple translation is many smaller firms are paying more for inputs, passing some of that cost along, and still feeling worse about growth and hiring. That is not the same world Micron is living in. Micron is announcing $250 billion domestic manufacturing plans. A lot of small businesses are just trying to not get kneecapped by higher input costs and a shakier demand outlook. This is why I do not like lazy versions of the phrase, the economy. Which economy? The mega cap industrial AI buildout economy? The tariff-exposed small business economy? The squeezed North America consumer economy? Those are not behaving the same way. And on July 9th, the market basically rewarded one of them and mostly ignored the stress in the others. That does not mean the market is irrational. It means markets price marginal power. And right now, the firms with the most marginal power are the ones with strategic scale, political relevance, and enough financial room to spend into the next cycle. If I am mapping the pressure points, that makes this day less about stocks recovered and more about capital continues to choose the strong over the exposed. That is a more useful frame than calling it a relief rally and moving on. You can see the same split if you leave chips for a second and look at PepsiCo. PepsiCo gave us a pretty useful consumer checkpoint. The company beat revenue expectations overall. That matters. But AP reported that demand was weaker in North America, where snack volumes were flat and beverage volumes fell 4%. The reason is not mysterious. Gas prices were taking more space in household budgets, so some of the easy impulse purchases got harder to justify. That is not recession siren material by itself, but it is a very useful piece of texture because it reminds us that beneath a green S&P day, there is still a consumer that does not feel especially carefree. The rough translation is international performance looked healthier, North America was softer, and budgets were tighter. That sounds a lot more like the real economy a lot of people live in than the headline move in the NASDAQ. So now we have three layers of the same story. Layer 1, oil eases and yields ease, so the market bounces. Layer 2, AI infrastructure names get the strongest vote of confidence because investors still want the domestic buildout. Layer 3, small businesses and consumer-facing operators are still dealing with tariffs, input costs, and tighter budgets. This is the uncomfortable part of the rally, and it is exactly why I do not think the green close should be read as broad comfort. It was selective comfort, or if you want the less polite version, Wall Street still has plenty of money for the AI machine. Main Street is still being asked whether it can absorb one more cost increase without making that face people make at the grocery store now. That is not a joke so much as a public service observation. The point is that the same macro backdrop can create optimism in one part of the market and pressure somewhere else at the exact same time. That is what makes this a useful chapter in the bigger picture series. Now zoom out from companies and look at the economy underneath the market. The labor signal was stable but not roaring. AP reported that jobless claims dipped by 2,000 to 215,000 for the week ending July 4th. That is still a low layoff number. So no, this was not a labor market panic day. But the same report also pointed back to the June jobs report, where employers added only 57,000 jobs. That is the kind of number that says layoffs are still low, but hiring is clearly more cautious. This is the labor market detail I would not skip. A labor market can cool in two different ways. One version is everyone is getting fired. That is the scary version. The other version is companies are not firing much, but they are also not rushing to hire. That is less dramatic, but it still changes how households behave. Then housing gave us another piece of the same puzzle. AP reported that existing home sales fell 2.4% in June to a seasonally adjusted annual rate of 4.09 million. At the same time, the median sales price rose to $440,600, an all-time high in the data AP cited from NAR. So housing is still doing that annoying thing where demand is weak, but prices are not exactly giving buyers a break. That is a strange economy for beginners to understand, but the basic idea is simple. High mortgage rates hurt affordability, limited supply keeps prices sticky, and a lot of people who already own homes do not want to give up older, cheaper mortgages. So when long-term yields move, housing cares, the stock market can cheer a tiny dip in the 10-year yield. But for a family trying to buy a house, rates in the mid-4s on the 10-year and mortgages still high enough to sting do not feel like a victory parade. That is why I want this brief to include housing and labor. Even if neither one was the flashiest market headline, they tell us whether the green tape is lining up with the real economy. And the honest answer is only partly. Labor is holding up better than feared. Housing is still strained. Consumers are selective. Small businesses are still cost sensitive. That is a much fuller picture than simply saying stocks went up, so the day was good. A few quick hits before the closing section. First, the natural gas backdrop was not screaming emergency. EIA said working gas and storage was 2,183 billion cubic feet for the week ending July 3rd, up 61 BCF from the prior week and 185 BCF above the 5-year average. That matters because it helps explain why the market did not treat every energy-related headline as equally dangerous. Oil risk was hot. The broader U.S. gas storage picture was more stable. And that is a helpful distinction if you are trying to understand the AI infrastructure story without getting lost in commodity alphabet soup. Oil matters because it hits global shipping, transport costs, inflation expectations, and the general fear level very quickly. Natural gas matters because a lot of the U.S. power system still leans on it. If you are building data centers, chip facilities, cooling infrastructure, and all the other power-hungry parts of the AI stack, you care a lot about whether the domestic energy backdrop looks constrained or at least manageable. So July 9 gave us a weird but important mix. The global oil risk was still obviously real. The Middle East headlines were not fake, but the domestic gas storage picture was not flashing the same kind of alarm. That helps explain why the market could calm down without becoming complacent. Simple version. The world still looked dangerous, but the part of the U.S. energy system that feeds a lot of industrial and power demand did not look like it was about to fall apart immediately. That is not the same thing as cheap power forever. Grid constraints, transmission, utility regulation, and data center demand are still huge issues. But it does tell you why investors were willing to separate oil scare from full energy panic. Second, this may matter a lot when bank earnings start. If the banks sound broadly healthy and credit conditions do not tighten further, the market may keep giving the benefit of the doubt to the rally. If banks sound cautious and consumer credit stress bleeds through, this week's selective optimism could look much narrower very quickly. Third, I would not overread one good AI day as proof that every giant build-out is justified. The market loves the future right up until it asks for receipts. And receipts season is basically what earnings are. Here is the connection I do not want to lose. Micron and PepsiCo are not random stories sitting next to each other. They are two sides of the same economy. Micron represents the part of the market that can still raise capital, build capacity, secure inputs, sign long contracts, and sell investors on a bigger future. PepsiCo represents the part of the economy where the customer is still counting dollars at the gas station and the grocery aisle. Small businesses are the third piece. They are not announcing $250 billion investment plans. They are trying to manage tariffs, input costs, and customers who are already picky about price. So the same market that rewarded Micron for helping build the AI machine is still showing pressure in the businesses and households that have to pay the cost of the physical economy. That is why I would not call July 9th just a green day. It was a capital selection day. The market was choosing who gets the benefit of the doubt, and it was not choosing everyone. One quick term before we wrap. When I say the market is rewarding the companies that can absorb costs, I mean companies with enough profit, financing, access, and strategic leverage to keep investing even when money is expensive and inputs are messy. That matters because the next phase of AI is less about having a cool demo and more about whether you can actually finance fabs, sign long contracts, secure materials, and keep margins from collapsing while you do it. So who benefits and who gets squeezed here? The winners, at least for now, are the AI infrastructure builders, the chip suppliers, and the companies that can secure domestic inputs and keep spending through volatility. The pressured groups are smaller tariff-exposed firms, consumer-facing businesses dealing with tighter budgets, and the broader parts of the economy that still need a lot more rate relief than they have actually received. Housing belongs on that list too. As long as the 10-year is living in the mid-4s and the 30-year is around 5%, housing is not exactly getting a spa day. The labor market sits somewhere in the middle. Low layoffs help, slower hiring does not. So the labor read is not bad. It is less comfortable than the headline claims number makes it look. This is where I could be wrong. Maybe the July 9 rebound broadens a lot more than I expect. Maybe oil keeps cooling, yields settle down, and the market starts rewarding a much wider set of businesses instead of mostly the strategic AI and chip names. Maybe small business pressure eases faster than the New York Federal Reserve research implies. Maybe consumer-facing companies sound better over the next few weeks than PepsiCo did. Maybe housing stabilizes if mortgage rates ease. Maybe low layoffs matter more than slower hiring. And maybe Micron-style spending ends up being a rational response to real demand rather than the kind of CapEx enthusiasm people regret later. Those are all real possibilities. But as of the July 9th close, I do not think the cleanest takeaway is everything is fine again. I think the cleaner takeaway is the market got calmer because oil and yields eased. But it is still being selective about who gets the capital and who gets the pressure. Here's what I would watch next. One, Brent crude. If Brent keeps fading toward last week's levels, the market can keep treating the oil scare as contained. If Brent gets back above $80, the relief story gets much shakier. Two, the long end of the Treasury market. If the 10-year stays closer to 4.5% than 4.6%, that helps the preferred trade. If it moves back above 4.6%, the market has to reprice the growth math. Three, housing and labor. If jobless claims stay low but hiring keeps slowing, the labor market is not breaking, but it is losing speed. And if home sales stay weak while prices stay high, affordability remains one of the quiet pressure points under the economy. Four, big bank earnings. I want to hear what they say about credit cards, auto loans, commercial real estate, loan loss reserves, borrowing demand, and the real tone of the economy underneath the indexes. Five more Micron-style announcements. If more companies start locking down domestic inputs, long contracts, and industrial capacity, then the AI as an infrastructure state-building story gets stronger. But I want to separate funded contracts from big ambition. Announcements are easy. Financing supply agreements and real customer demand are the receipts. Six, consumer-facing earnings watch volume, not just revenue. If companies are growing sales mostly through price while volumes stay weak, that tells us consumers are still resisting. If they keep sounding more like PepsiCo than like the AI winners, the split economy red stays alive.